Good morning. Thank you for dialing in today to hear from Tim Schroders, who is co-manager of the Pengana Global Resources Fund, share his insights into the resources and commodities sector and why there is value in the current environment and what the key opportunities are, and whilst being mindful of the risks. Not a day goes by where there isn't press coverage regarding names we all know, such as BHP, Glencore, Santos, Fortescue, and the market is starting to see contrarian investors comment about the long-term opportunity and value in the sector. Given resources are a major part of global equity markets, representing over 20% of the global investment universe, it's imperative to include a strategy to take advantage of the full universe and opportunities available. I'll hand it over to you, Tim, and let's share your thoughts.
Thanks, Rebecca, and welcome to everyone. I'm Tim Schroders, co-manager of the Pengana Global Resources Fund. What we're going to try and do is walk you through some of the pertinent points with regards to the resources market at the moment, and in particular, I encourage people to save questions until the end of the webinar, and I look forward to some interactive discussion at that point. So we'll begin with what we're going to cover today. The agenda is there. First, we'll discuss the current environment. It's a difficult environment, but there are opportunities. Secondly, we'll talk about what those opportunities are. We'll talk about particular areas that are advantaged by what are seemingly difficult circumstances. And finally, we'll sum up with portfolio positioning and the portfolio where it stands today, along with current performance. Not surprisingly, the environment has been challenging, and perhaps more so than what I would have thought at the start of the year. The environment's been difficult in terms of equity prices suffering from earnings downgrades as a consequence of commodity prices having fallen far greater than what we had thought and what the majority of analysts out there in the broking community would have thought. Over the past 15 months, we've seen commodity prices as a basket fall nearly 30%. However, what's been surprising is mining equities have suffered a capitulation and fallen far greater, in fact, than what we've seen the commodity prices fall. Just to create a bit of colour around what those commodity prices have done, year to date we've seen iron ore down roughly 30%, oil price down about 13%, and the copper price is down around 20%. Not surprisingly, what we've seen is something similar yet very different with respect to the way oil equities have tracked oil price. Oil price is down about a third in the last 15 months. Sorry, down six. The oil price is down about 60%, yet what we've seen is roughly oil equities have fallen about half of that. And that's a very different scenario than on the prior slide, where we've seen the metals and mining equities be far more severe in terms of reflecting the downgrade. It's somewhat surprising to sort of see things moving very dramatically and very differently with respect to oil equities relative to mining. And even within different markets, we're seeing very disparate performance. For example, in the Australian energy sector year to date, we've seen equities fall around 26%. The likes of Santos, which have had well-documented issues around their balance sheet and market nervousness about the way forward with respect to their LNG initiatives in Queensland. And most recently, Origin has suffered and fallen out of favour as a consequence of a stretched balance sheet and a number of issues pertaining not only to their LNG and coal seam gas businesses, but also their utilities business. Last week they instigated a repair program where they raised over $2 billion to repair their balance sheet. But nonetheless, what we've seen is some fairly lumpy falls out of major stocks in the Australian market. By comparison, what we have seen is overseas equities in the oil and gas sector hold up reasonably well. So year to date, the MSCI World Energy Accumulation Index, translated into Australian dollars, is roughly flat. So there are enormous opportunities if you're in the right parts of the right markets to exploit current weakness and current volatility. Part of the weakness that we're experiencing year to date, and most recently in the last quarter, has been market concerns and indeed worries about the trajectory of the Chinese economy. The Chinese economy, the focus on that relative, what's been a very good, positive component to growth over a number of years, and indeed since the start of this millennium, is now being questioned as Chinese growth slows, and importantly what we're seeing is the components within the Chinese economy start to change as maintainability becomes more of a focus for Chinese authorities. On this graph, what we're looking at is Chinese GDP, which remains very healthy in a world context at around 7% per annum, and that's the orange line, and what we're seeing is industrial production growth relative to GDP growth, which is the white line. And what we've seen over a number of years, and indeed since the start of the millennium, is industrial production growth has been running in excess of 20% for the majority of that period, and currently is trended down to below the growth rate of GDP. So the components and the way the Chinese economy is formed is changing, and we can't get away from that. It's becoming less reliant on the early cycle industrial production, fixed asset investment that propelled it for so long, for a very sustained period of time, and it's transforming to more of a domestic consumer-based economy, less reliant on exports and more services oriented. And this is no doubt going to have an effect on future metals demand or commodities in general. But importantly, what we're seeing is the Chinese economy growing at a slower rate, but off a much more significant base. And by that I mean, for the last 20 years, Chinese GDP has increased 17 times, not 17%, 17-fold from where it was in 1994. And that's a massive change to a point where the Chinese economy is now the second or third largest economy globally. The consumption, whilst the growth rate may slow, it's off a significantly higher base. Further to what I was talking about on the previous slide, the fixed asset investment component of Chinese GDP has been decreasing for some time. And significantly in the last 12 to 18 months, we've seen a step change downwards. It's now trending at about 10% growth, which is still quite reasonable, but understanding the components of fixed asset investment, be they real estate, infrastructure and manufacturing, we're seeing a real estate glut at the moment, which is taking some time to work through within China, but it's not a disaster at this stage. Significant infrastructure spend that occurred earlier in the last 10 years in terms of roads, ports, etc., that's unlikely to be replicated in the future, similarly with rail infrastructure. But what we are seeing is significant continued expenditure in areas like the power grid, for instance. So the components and demand for raw materials is changing significantly from things like iron ore, which the economy was heavily reliant on over the previous 10 years. Now copper, aluminium are becoming more significant consumed parts of that growth moving forward. And again, it's understanding what bases we're dealing from and where these companies that are selling into China are coming away. So if we look back for BHP, for instance, in 2001 they were selling roughly 58 million tonnes of iron ore out of the Pilbara, and a large proportion of that was obviously into the Chinese economy. For this current financial year, BHP is going to produce around 240 million tonnes. That's a fourfold increase from the start of the millennium. So what we're seeing is, yes, the rate of growth slowing, but off quite a spectacular growth rate if we look back in the last 10 to 15 years. And that's just a contextual understanding that, yes, we're seeing growth slow. It's not a disaster, but we are seeing a differentiation between supply-side growth and demand-side growth, and that's being reflected in some weak prices currently. What we're seeing at the moment, and I've talked about this in the previous slides, is basically what we're seeing is slow growth, and overnight the IMF downgraded global GDP forecast to about 3.1% for the current year, which is the lowest since the global financial crisis. So growth is okay. There's significant stimulus in terms of what we're seeing with QE, protracted low interest rates in the developed economies, and significant weakness most recently in some of the developing economies, be it South American economies such as Brazil, Argentina, significant slowdown in the likes of China and Russia. So the world is growing, but not to a point of escape velocity, and what we're really lacking at the moment is stronger, sustained, synchronous growth, which is what we're all after in terms of arresting some of the oversupply that we're seeing in commodity markets currently, but also soaking up excess supply and building out new capacity. So capacity utilisation rates in the global economy are below the threshold where new capacity in a number of industries needs to be built. What the current environment lends itself to is producers that would have been priced out of the market are, not surprisingly, surviving longer and maintaining their production and their businesses without going out of business. It's not a surprise. We see this every cycle. When things get more difficult, people's initiative and ingenuity find a way to do things smarter and for less cost. So as a result, what we're seeing is the displacement of higher cost capacity in a number of industries is taking a longer time to work through, and as a result, weakness is maintained and supply isn't disrupted as quickly as most analysts would have thought. Balance sheets at the moment for a lot of these companies are being exposed. The good companies with strong balance sheets are being rewarded. Conversely, what we're seeing is weak balance sheets, and in fact, balance sheets that were constructed in a pre-GFC environment where you had rising commodity prices, falling cost of debt, and an environment that encouraged production and sales growth. There's now a few companies that are slowly waking up that that's not a sustainable model in the current environment, with lack of commodity price growth, pressure on margins, and more focus on returns, adequate rates of returns that should be generated by these companies by providers of equity. As a result, what we're seeing is, whilst prices are falling, costs have been spiralling down faster, and as a result, what we're seeing is companies that we thought wouldn't be able to maintain a positive cash margin are able to cling on longer, and we're seeing that not only by the company's own making, but also through currency translations. So, for instance, in Australia, the Australian dollar is down about 12.5% since the start of the year. We're seeing a similar type fall in the Canadian dollar, and this has the effect of translating cost curves where companies might have been uncompetitive a year ago to a point where they're now fairly competitive, and as a result, we're seeing companies that were well placed a year ago, who may have been US dollar denominated costs and mines operating in the US, now being displaced and pushed into third or fourth quartile on the cost curve. It's a challenge. It's a rapidly changing environment, but it's also an environment that's highly conducive to some fairly significant opportunities. The graph on this current slide represents the Australian dollar gold price, and whilst we've seen very dramatic falls in a number of commodities in recent times, the fact is we've seen a 16% rise in the Australian dollar gold price in the last 15 months, and a refocus by some of those companies within the Australian sector on reducing their costs, providing a sustainable business model and addressing their balance sheets to ensure a more reasonable balance for the next 5 to 10 years. It's not surprising that what we've seen against that backdrop is a re-rating of the Australian gold producers, particularly obviously the producers that have Australian domiciled mines, and they're also benefiting not only from the higher gold price received in Australian dollar terms, but also a significant cost component within the industry is fuel for the big trucks and mining fleet that they run. And what we're seeing with a low oil price, low diesel prices as a result of a low oil price, that the costs are also moving downwards. So we're seeing an environment of significant margin expansion. And some of these companies are trading on 10 to 12 times earnings, which stacks up not only in the resources sector, but in an overall market sense, where the overall market's probably trading on 15 to 16 times PE, and in a lot of cases this is a free option on upside that's not available in other parts of the market. Another area that we've identified some significant opportunity has been in the US refining sector. US refiners over the past 12 months have seen earnings per share estimates for the current calendar year, in December 2015, revised up roughly twice what they were 12 months ago. This has been as a result of lower oil prices for longer, so people were expecting a stronger snapback in the oil price, which hasn't eventuated. The refineries which convert the crude oil into products such as gasoline or jet fuel, etc., what we're seeing is strong demand for the end products such as gasoline as the price of that's fallen. There's been higher utilisation rates within the refineries, and the companies themselves have restructured their balance sheets by utilising master level partnerships and moving some of their infrastructure assets off their balance sheets, providing a freeing up of capital whereby free cash flow is increased, and that free cash flow in a lot of instances has been utilised in the form of share buybacks, which has again tightened stocks, provided earnings per share uplift and a significant re-rating for the underlying stocks. It's an area that we see considerable value not only today but into the future, despite what may well be not maintained current strength. So we would expect some moderation in the refining margins that the current environment has, but maybe not to the extent that the market's predicting a fall off in those margins over the next 2 years. I think what we've seen is a structural change in the industry. The companies are working their capital harder, they're doing things smarter, there are significant barriers to entry for new players, and as a result I continue to see a favourable outlook and favourable share price performance for these companies. So over the next 6 months we'll look to add to our positions from current levels. The small cap area of the market's been a very difficult part of the market to play in, and not surprising. What we've seen is a number of factors add to difficulties in the small cap area, and I think from an Australian equity point of view, what we've seen is significant IPOs in the small cap industrial part of the market that have attracted capital, probably to the detriment of the resources sector, but also competing for capital in a broader level has become more difficult for companies looking to develop new projects, and to that extent the last 3 to 5 years in the small cap space has been a very difficult environment for every investor. There's been some stellar winners, but some spectacular losers. And there's a crisis of confidence. But importantly, what we've seen is a lot of investors in a generalist sense, and even in the resources space, shy away from looking at special situations. We continue to look and do a lot of work on companies within the sector because we see favourable outcomes persist for very unique situations. And what we're seeing is under-researched situations, poorly understood by the market, providing some fairly significant opportunities. And most recently, in the last quarter, we've increased our small cap part of our portfolio from less than 14% at the end of June up above 20% as at the end of September. This slide just goes to represent that, despite very weak small cap index returns, we've identified 4 very good performing companies. Indeed, all of those companies at some point in the last 2 years have grown in excess of twice what we bought them at. And what we've seen in a lot of instances is those gains have been short-lived. The important point here is you need to adapt your strategy to suit the environment, and a set and forget type strategy in the hope that these companies continue to go up at the rate that they have over a short period of time is not reasonable. And indeed, what we've seen with some of the companies that we've successfully invested in is they've changed strategy midstream as they've got some currency and some traction in their share price. They've gone on to divert from the things that made them attractive to try and expand and move into other projects, and diluted what people had originally bought into, but importantly changed the risk profile to indeed become a lot more risky. That's been a problem, but we've been very diligent in holding these companies to account and understanding the changing dynamics very quickly and being able to exact value and, importantly, keep it within the portfolio. Finally, in conclusion, what I've ostensibly outlined is this is not the bottom of the market. It's not an environment that all boats float on a rising tide. It's a discerning market where we're seeing different outlooks for different industries within the broad resources space. In the current environment, rebalancing of some of the individual commodity markets is taking a lot longer than what we thought at the start of the year, as companies have proven more adaptable in adjusting their businesses to a more difficult price environment. So lower for longer, maybe another 6 to 12 months is the likely scenario as a consequence of that. We're starting to see a recapitalisation of some of the more highly indebted companies within the sector. To that end, we saw last week Origin have a successful equity issue and basically change its balance sheet, along with a stricter application of future capital in the way it pursues its business on an ongoing basis. And I expect that will be the precursor to a number of recapitalisation stories, which in turn will provide opportunity for us to increase the fund's net exposure into companies that we presently don't own over the next 6 months. What was also interesting last month, and indeed in the last week or so, was the aggressive sell-off that we saw in Glencore, where the company lost 30% of its value in one night as a result of largely innuendo and rumours and heightened hedge fund activity as a result of attacks on credit default spreads, repricing of its debt, and in turn repricing its equity. This tells me that we're close, if not past, a capitulation stage in the resources market, and whilst this isn't necessarily the bottom, it's the type of activity that we do see close to bottoms of the cycle. So watch this space. It's by no means over, but it's interesting nonetheless that you can see such a large company and such a volatile and nervous reaction in what has been a fairly significant few weeks for the resources market. Finally, with regards to M&A, we probably haven't seen as much as what we would have thought at the start of the year, but significant action in a number of key areas, particularly in the oil and gas area. BG has been bid for by Shell Group. We've seen in recent days Suncor continue to look to expand its oil sands business, and even in the last month or two we saw Woodside launch an unsuccessful bid for Oil Search, albeit it was basically an indicative offer. So there is movement beneath the surface, albeit on a very selective basis, but we're not into a heightened M&A cycle just yet. Yes, we'll sum it up now, and please, if anyone's got any questions, feel free to ask.
Well, if there, I'll leave it another if anyone has any questions, please do type away. I'm happy to answer them. Oh, yep, here we go. All right. So the question is, there seems to be a significant glut of resources globally. Is this a short or longer term concern?
Look, I think it's both a short-term and longer-term concern, and it varies from commodity to commodity. What we've seen is, during the resources boom, there was commitment to develop new projects at a time when the resources, and I'm talking about human capital, the ability to get permitting done, to design mines, to do all the associated infrastructure, the capital involved and the wherewithal to bring in new projects on time, on budget, wasn't there. Everyone was trying to do the same thing at the same time. They were competing for a limited pool of experienced people to develop new mines. As a consequence, what we saw was a delay in the onset of new mines being built, and importantly, the production from those mines. This is occurring at exactly the same time as demand growth is falling. So we are going to go through an imbalance period that may last longer for the next couple of, basically for probably 18 months to 2 years longer than what we would have thought at the start of this year. Ultimately, that's a positive environment, because what we're seeing, the low prices today and the higher demands for returns, adequate rates of returns on capital, are seeing dramatic reductions in exploration expenditure, but also higher demands on new projects that have to achieve an adequate rate of return before people are going to commit to them. So it's a very good environment longer term, because we're not seeing new projects being committed to, but the current glut may in fact last a bit longer than what we would have thought.
All right, another question. Does the fund have a holding in Origin, and if so, did the fund take up its rights?
The fund hasn't had a holding in Origin, and we've sidestepped that one for a number of years. We found the company historically to be expensive, and particularly when it committed to its coal seam gas to LNG strategy. We didn't think that the share price adequately reflected the risks associated with that. But importantly, what we've also identified for a number of years is the underlying utilities/electricity business has in fact been absorbing a lot more capital, and margins have been under threat for a lot longer. Having said that, we think that the steps taken in the last week are very encouraging, and we're readdressing the situation regarding Origin today, and in the next week we think the risk-reward profile's changed. The upside's probably less, but so's the downside. So that's where we sit at the moment.
Okay. What are your favoured sectors going forward? AED, gold spot, palladium over platinum due to fallout
Volkswagen.
of VW saga?
It's a really good question. In terms of favoured sectors moving forward, Aussie gold, I think, is becoming a fairly accepted area where the market, not only for resources specialists but also for generalist funds, are migrating back to. What we're ostensibly seeing is margins of the vicinity of 40%, which is attractive in anyone's language, combined with relatively low PEs, seeing generalist managers, not only resources managing, circulating back. What we're seeing in what's making the outlook for other commodities more difficult is high amounts of volatility. Palladium and platinum are indeed interesting, but very peculiar with respect to finding companies that can adequately produce in an environment that's not got a lot of other things undermining the ability to produce profit. So whilst we've been long-term bullish on the platinum group metals as a bundle of commodities, which they've been actually very poor performers in the last 12 months, what we've always had difficulty in an equity sense is finding good quality, reasonably priced equity exposure, understanding that the majority of platinum and palladium comes out of either South Africa or Russia. And the listed entities that produce the majority of that output are mostly flawed, and we've had difficulty from a bottom-up perspective committing to those assets. Having said that, there will be some significant opportunities, but we're not looking at the Volkswagen incident per se as a means to rotate back into any of those stocks at the moment.
All right, and I think we've got one more. Does your fund invest in any uranium stocks, and do you have a view on the price outlook for uranium?
Yeah, look, we do invest in uranium stocks, both direct and indirect. So companies such as BHP through their Olympic Dam operation, Rio Tinto have got uranium exposure, but also we own probably the largest listed uranium producer in the world called Cameco Corporation. The outlook, and this is an outlook that if you asked me for the last 20 years, I could have repeated this response and it would have been probably right every time. The outlook on a 5-year view looks good in terms of new reactor build, demand exceeding apparent supply, and the price should move up. But what we've seen is a history of disappointment where, for whatever reason, and the latest reason was obviously the Fukushima disaster in Japan, that imbalance and sustained upward price momentum in uranium has always been disappointing. So do I see a longer-term favourable outlook for uranium? I think downside is limited and probably less downside than a lot of other commodities, but the upside may take a little bit more time to come to fruition as well. But importantly, what we're seeing there is current low prices in uranium's limiting new supply, which the incumbents are at a significant advantage versus anyone trying to build a new mine. So that's why we're positioned the way we're positioned.
All right, well, thank you, Tim. And if there aren't any further questions, I will close today's webinar. I think it's fair to say that today's macro environment remains challenging for investing in the resource sector, which makes it all the more important to identify companies that are not correlated to commodity prices and have greater control of their own destiny. And a specialist approach like Tim and the Pengana team can assist with sourcing companies with robust balance sheets, with cost reductions, and even some that benefit from lower commodity prices. So being exposed to the right industries at the right time helps better mitigate risk and improve portfolio returns. Thank you for dialing in. Please do not hesitate to contact Pengana should you be interested in more information, and CPD points and slides will be emailed to you shortly. Thanks.
Thank you, and have a good day.